Is now the right time to invest in UK housebuilder stocks? That's a question many investors are asking right now. The world of stocks and shares is a complex landscape, and when it comes to housebuilder stocks, the terrain can be particularly challenging to navigate. Demand, dividends, and interest rates, these are some of the key factors that can influence the performance of these stocks. Demand for housing is driven by various factors, including population growth, economic conditions, and government policy. Dividends, on the other hand, are a return on investment for shareholders, and their sustainability can be a sign of a company's financial health. Interest rates, set by central banks, have a significant impact on borrowing costs, which in turn can affect the profitability of house builders. Each of these elements brings its own set of challenges and opportunities. In this video, we'll delve into these key factors to help you make an informed decision. First, we must examine the demand for UK housebuilder stocks. In the grand scheme of the investment world, demand for these stocks is largely influenced by the broader housing market dynamics. In the United Kingdom, we've seen a persistent imbalance between housing supply and demand. This imbalance has been a driving force for house prices and consequently the profits of house building companies. However, the landscape is not as simple as it might appear. Recent events, such as the COVID-19 pandemic and Brexit, have added layers of complexity to this dynamic. The pandemic, for instance, triggered a seismic shift in living preferences, with many opting for more spacious accommodations away from city centres. This in turn boosted the demand for new houses and, by extension, the stocks of house builders. On the other hand, Brexit introduced uncertainties in the market. Potential restrictions on immigration could limit the availability of skilled labor, potentially hindering the ability of house builders to ramp up supply. This too has implications for the demand for their stocks. In the midst of these complexities, it's important to note that the individual performance of house builders can vary significantly. Factors such as their financial health, dividend policies, and strategic decisions can sway investor sentiment and influence demand for their stocks. For instance, companies like Persimmon, Taylor Wimpey, and Barratt Developments have historically offered high dividend yields, which can be an attractive proposition for income-focused investors. Moreover, the prospect of rising interest rates can also impact the demand for housebuilder stocks. Rising rates can make mortgages more expensive, potentially cooling off the housing demand and putting pressure on housebuilder profits and their stock prices. So demand is a complex factor, influenced by numerous variables, but it's essential to consider when evaluating these stocks. Next, let's look at dividends. A key reason why investors are drawn to UK housebuilder stocks. Dividends are a portion of a company's earnings, paid out to shareholders as a means of sharing the company's success. UK housebuilders such as Persimmon, Taylor Wimpey, and Barratt Developments have historically offered attractive dividend yields, making them a popular choice for income-focused investors. However, the current economic climate has cast a shadow over the future of these dividends. Rising interest rates and housing affordability are two key factors putting pressure on these house builders' financial prospects, which could affect their ability to maintain their dividend payments. The affordability of these dividend payments is assessed through what's known as the dividend coverage ratio, a crucial metric for their sustainability. A closer look at these companies shows how they're reacting to these pressures. Persimmon, for instance, has announced changes to its dividend policy to prioritize its financial position during this challenging period. Taylor Wimpey aims to pay twice-yearly dividends, amounting to about 7.5% of its net assets. Barratt Developments, on the other hand, has also altered its dividend policy, but a tough operating environment may lead to declining dividends. Despite these near-term challenges, the long-term prospects for house builders remain positive due to housing supply and demand imbalances and a likely decline in inflation. However, dividends in the sector are expected to fall before rising, so investors interested in these stocks should be prepared for some volatility in their income. While historically high, dividends from these stocks may come under pressure due to the factors we've discussed. It's a delicate balance, and as with any investment, diversification across different sectors can help manage the risk. Finally, we must discuss interest rates, which have a significant impact on all stocks, including those of UK housebuilders. Interest rates are like the heartbeat of the economy, and when they fluctuate, so too does the pulse of the housing market. When rates are low, borrowing becomes cheaper, stimulating the demand for houses. This can lead to increased profits for house builders and in turn drive up their stock prices. Conversely, when rates rise, borrowing becomes more expensive, potentially cooling off the housing market. Now let's bring this into the context of today's economic climate. Central banks have been hinting at interest rate hikes to combat inflation, and if these hikes do materialize, they could put a dampener on the housing market. Borrowing costs would rise, possibly slowing down the demand for new houses. House builders like Persimmon, Taylor Wimpey and Barrett Developments could feel the pressure. Their stocks could see some volatility as investors weigh the effects of these interest rate changes. But it's not all doom and gloom. Remember, these companies have weathered interest rate cycles before and have strategies in place to navigate this economic landscape. However, it's not just about the direct impact on house builders. Interest rate changes can also affect investor sentiment. If rates go up, bonds and savings accounts might start to look more attractive compared to stocks, leading to a potential sell-off in the stock market. So, while we can't predict exactly what will happen, we know that interest rates can have a profound impact on the housing market and, by extension, house builder stocks. It's a delicate balancing act between the cost of borrowing and the demand for housing. Interest rates, then, are a crucial factor to watch when considering an investment in these stocks. We've delved into demand, dividends, and interest rates, but the question remains: is now the right time to invest in UK house builder stocks? We've seen that demand remains high due to housing supply and demand imbalances. Yet dividends are under pressure from rising interest rates and affordability issues. Companies like Persimmon and Taylor Wimpey have adjusted their dividend policies to weather these financial challenges. Meanwhile, interest rates are a double-edged sword. On one hand, they tighten the financial prospects of these companies, but on the other hand, they may create buying opportunities as share prices adjust. We've also touched upon the cyclical nature of house builders, which means their earnings can be volatile. And let's not forget the global economic factors such as inflation and the ongoing pandemic, which have been causing waves in stock markets worldwide, including the FTSE 100. Weighing these considerations, it's clear that there's no definitive answer. The timing of your investment in UK house builder stocks largely depends on your individual risk tolerance, investment goals, and market outlook. Ultimately, the decision is up to you, the investor. We hope this video has provided some valuable insights to guide your decision-making process.